We're delighted to have John Willman join us this weekend. John Willman is the editorial consultant and former UK business editor and associate editor of the Financial Times.
Of course, for the richer countries up in Northern Europe, like Germany and the Netherlands and Finland, their currencies would rise, and that would make their exports less competitive. That's what they've been protected from when being a member of the Eurozone. They haven't had to let their currencies appreciate because they've become more productive and more wealthy. That would then be a period of great competition, and it would be great turmoil, and I think it wouldn't do business activity a huge amount of good in Europe, because suddenly, I mean, the wonderful thing about the euro is it created this whole zone where there was free trade, and actually even that was good for Britain as well. It was the single market was the real step forward when there was a single market in goods. So say a company like Unilever that makes washing powder, which used to have sort of about 12 or 15 plants all over Europe making their washing powder, their detergents, suddenly reduced it to 2, which are much bigger and much more efficient, because they could ship the washing powder around Europe without paying any taxes or import duties or anything. And the euro made that still easier. It made it still easier. So, particularly on mainland Europe, where people work across borders already to some extent, if you're in Western France or Eastern Germany, people are crossing the borders all the time. It was much easier to do business and not to incur costs of changing money. And having lots more currencies puts up the cost for everybody.
It's interesting, as you've mentioned, about the tremendous benefit of a single market, something that American listeners may be aware of, the fact that there are 500 million citizens within the European Union, which is a huge market.
Exactly.
And at the same time, if countries within the EU or those that aspire to join the EU are able to address some of these fundamental issues of strengthening the rule of law, focusing on structural reforms, and as you've clearly indicated in regard to Greece or some other countries that are facing significant economic challenges, to address some of these issues on, for example, the retirement age and other aspects of privatization and so forth. We would certainly see a different Europe, a Europe which is more robust in its trade and within the EU and beyond. So there is certainly potential for the European Union if it is able to address those fundamental issues.
Yeah, there's very much a feeling in southwestern Europe, so I'm including France in that somehow, if Europe is determined enough, it can challenge the pressures that they get from the markets. And those, pressures in the currency markets, the capital markets, and also the product and services markets. That somehow, if we're a big enough group, we can dictate the terms of trade. And I just don't think that's true. And I think, all the time they're trying to resist globalization. Actually, globalization is quite unpopular in big tracts of Europe. And yet the paradox is that a lot of European countries have been huge beneficiaries from globalization. France in particular, funny enough, where there were 11 industries that they refused to allow to be taken over by foreigners, where branches of McDonald's get burnt down from time to time. There are more branches of McDonald's in France than there are in any other country in Europe. And at the same time, there are great international companies, French companies, trading all over the world, like Danone or their defense people, their train manufacturers, all these sorts of people, really world-beating products. And also, interestingly, one of the things I noticed when I was at the Financial Times was the language of the French boardroom was increasingly becoming English. Now, this wasn't because English mattered to them hugely, but it was because nearly every one of them would have an American, a Canadian, and maybe a Brit on their board these days, because they were such international companies. And unfortunately, while most Europeans can speak English pretty well, most English speakers can't speak European languages very well. So the whole company has to do its business in English. But that was just a symptom of how international they've become. As soon as you had one American on your board, suddenly you had to switch to speaking English on your board. These companies are doing really good business all over the world, but they still tend to see, if they don't like something, they say we won't have it, even when the economic pressures are enormous to have it.
As you mentioned, the significant benefit of having English as a major language, or the number one language within Europe, it certainly benefits the UK in its trade with the Commonwealth. When looking at a rising India, which certainly has its difficulties and challenges, and it's working through it as we speak. And the UK truly has a natural trading partner with India, and with its growth, could certainly benefit from it. However, I've noticed in other parts of Europe there is a sense of reluctancy to bring in individuals from Asia and to augment trade. I think the European Union and Brussels has not done as much in the areas of free trade with India, free trade with a number of other countries. I certainly have been following some of the trade deals from the U.S. side as well. So if the transatlantic economy can look at Asia as a natural partner, I think we could certainly see greater benefits from it all.
Yes, although, I mean, this isn't the subject for today, but one of the things that's very worrying, really, is the extent to which the Asian economy is now grinding a bit more slowly. I mean, it's still, the growth rate in India or in China is something that we could only dream of in Europe or even in the USA. But they are slowing, and that's beginning to feed through in some ways. I mean, there was this theory after the the financial crisis, that somehow these countries had decoupled from the Western economies, and that they were going to go on doing fine, while, you know, the Western economies all ground along, bumping along the bottom while they sorted out their indebtedness and so on. But actually, it is finally catching up, and I think people in the know say it is actually because they're able to sell less products and services to the advanced economies that's actually causing it to slow up a bit. So I don't think there's no panacea in going east, young man. But you're completely right that there's a lot more opportunity out there, which European countries have been a bit sniffy about, and which also they're all putting up the walls a bit. I mean, that was one of the things everybody feared after the financial crisis, was that the walls would go back up between countries because they'd all seek to defend their own industries and their own currencies against foreign competition. And that didn't happen much at first, but you can see it in all sorts of ways now. And it's getting harder, for example, for banks to do business across borders. It's not impossible, but it's harder because governments suddenly are getting quite interested in where money flow goes. And in a funny sort of way, it's going back to what we were talking about earlier, the capital flight from Greece. Countries, they need to finance their own fiscal deficits. Everybody's got a fiscal deficit these days. I'm sure there is a country in the G20 or in the G8 that the 8 richest countries that does actually collect in as much tax as it spends, but I can't quite think which it is at the moment. But, you know, most countries in the G8 have very big deficits they need to finance, and the way they finance that is by finding ways of making people with money who live in their country buy their own bonds, whether it's through their pension schemes or through their insurance policies, or just by making it harder to invest abroad. So, you know, all these barriers are in danger of going up all the time. And then you also have the last few years has really been quite bad from the point of view of raw materials as well for commodities. And India has just been having some power cuts in the last couple of days, and one of the reasons they think this is happening is that the monsoon is late. Indeed, it may not come. And when that happens, Indian farmers have to start up their electric pumps and pump water up from underground reserves, and that overloads the national grid. They're having a huge drought in America as well. We were actually having a drought in Britain until on about the 30th of May, they announced there was going to be a hosepipe ban across the country for many months. And it didn't stop raining for 2 months after that. But, you know, the weather is doing a lot of funny things, and that has consequences, real consequences, for things like the cost of food and the cost of raw materials, which feeds through into prices. And in poor countries, if the price of a staple, you know, wheat or rice goes up a lot, that again leads to political instability and riots and this sort of thing. So, you know, it just seemed the 21st century seemed pretty good for its first 5 or 6 years, but since then it seems to have been going a bit, as we say in England, pear-shaped.
Maybe your final thoughts, John, on Europe, on European Union and the euro. Obviously, we need to increase economic growth, increase employment, bring more confidence to consumers for spending as well as to markets. It seems that, as you mentioned, a euro is indispensable at the moment. As you mentioned, you don't think there will be a division in that area. So there must be certainty in Europe must be part of the equation of the confidence for higher spending and spending in all areas. So what would you suggest in order to strengthen the euro and without losing sovereignty? Because obviously countries are not ready to lose more sovereignty in that respect.
Yeah, no, you're absolutely right. And actually, I hope they don't, because I think there's some great nations in Europe, and we don't want to lose those qualities of them. It is in the end all confidence, and it would seem to me that the biggest step that could be made, actually, is to sort out the euro crisis. I mean, if people, every day you get up and on the European broadcasters, if I'm traveling around Europe, you switch on the morning news and, most days the lead item is some other problem with the Eurozone. And because people did suffer quite badly after 2007, and they were really worried about their jobs, and a lot of people lost jobs, and a lot of people got them back again. But, it was a very bad time all over the world, not just in Europe. People were really worried. They lost confidence, I think. And at the same time, the other great problem is interest rates are now so low. I mean, they're about 0.5%, 0.75%. In the euro, they're actually nearly 2%, but that's pretty hefty by international standards these days. So you can't even put your money in the bank and save it anymore. And if you've invested your money in shares, you're feeling very sorry for yourself over the last 10 years, because basically they've gone nowhere. And I think that's true in the USA as well. So nobody has any confidence. They're worried that these problems won't go away. Their savings don't seem to be going up very fast. And all these cuts that governments are putting through, and actually in the British case, we haven't had most of the cuts yet. They've all been announced, and people think they've happened, but they haven't. They're happening now. And that's when the crunch really comes, when people suddenly find there's less money in their pocket. Really, the thing that would most lift confidence, it seems to me, would be a boost to the euro. We're all in the euro here together. We have a proper fund. If anybody gets in trouble, we can bail them out. There's more than enough cash in the bank to do that, the European Central Bank, and slowly rebuild it. The second problem, of course, is that why did we have the financial crash? We had it because people had borrowed too much money. You and me, companies, governments had borrowed too much money, and they still owe a lot. And everybody knows they've got to repay some of that debt before things can start expanding again. So even if the euro was cured, I don't think we would see very fast growth over the next few years, but I think we'd begin to see, as the cliche goes, the light at the end of the tunnel. There's something a bit similar with this for the US. You've got much better economic growth over there now, but it's still lower than everybody thinks it should be. So you can see that, the housing crisis is slowly clearing in the US, isn't it? It's people are again able to buy and sell houses. They can even get, a mortgage, and that's getting the construction industry going again, and it's raising consumer confidence. If you can give people confidence, then they'll go out and do things. If they don't have confidence, probably very sensibly, they sit at home and count their pennies.
You're right when you mention the growth, and also when you compare the unemployment figures. Unemployment in the euro area exceeds 11% and is rising, while the U.S. economy is expanding, and unemployment is actually at 8.2%. Still high, but much lower than the European Union.
But not falling the way that people want it to fall. Incidentally, we talked about corruption a bit earlier in the discussion, and something I meant to mention at the time is Spain's official unemployment rate is over 25%, but nobody believes the figure, because there aren't 25% of the population of Spain not working. They're probably working in the black economy or the casual employment or whatever. So again, you have this basic problem that maybe because they don't collect the statistics properly, that things might look worse than they actually are, You go to a country like Spain and people do seem to have some money to spend, So it does come down in the end, confidence. Get that confidence, and then you could begin to see things beginning to accelerate a little bit, but not as fast as we'd all like.
John, we really appreciate your in-depth analysis, your feedback, your thoughts on the European Union, the Eurozone countries, and what is transpiring in the UK. John Willman is an editorial consultant based in London, and former UK business editor and associate editor of the Financial Times. John, it is such a delight to have you join us, and we look forward to our continued discussion in the days to come.
Well, thank you, Joel and Natasha. It's been a real pleasure to discuss these topics with you.
Thank you indeed, and we wish you well, and trust that you will enjoy the Olympics in your beautiful city.
Thank you very much.
This week, we reflect on the life and legacy of Milton Friedman, Nobel laureate who was born on July 31, 1912. Joel and I met with Milton and Rose Friedman at their residence in San Francisco in the summer of 2004. They were a very gracious and a wonderful couple. They were both great champions of liberty. During our meeting, I asked Milton Friedman how should we start with the reform process and how to sequence reforms. He replied, looking straight into my eyes, "You do not need much for societies or economies to prosper. What you need is the rule of law, protection of property rights, no customs, and no taxes." "No taxes?" I replied in astonishment. Milton Friedman was very serious and firm. "No taxes, or very, very low if you really need them." Friedman understood well that taxes can only keep rising, and making a case for no taxes, he actually encouraged more private initiative and limitations on government spending. Friedman's books Capitalism and Freedom and Free to Choose inspired generations of freedom fighters around the world. They provided a foundation for transition from communism to free market economy. Prime Minister of Estonia, Mart Laar, was one of those leaders who took Friedman's book Free to Choose as a guidebook for economic reforms in Estonia. Mart Laar would say, "I knew little about economics. I read Milton Friedman's Free to Choose and thought that all the economic reforms that Friedman was talking about had already been implemented." Laar's advisors were discouraging him from taking Friedman's path by saying, "You cannot walk on the water." But Mart Laar shared with us, "Because we did not think that it was impossible, we did walk on the water." Following Friedman's Free to Choose, Estonia implemented the free market reforms and became the Baltic Tiger, growing at about 10% per year until 2006. Estonia has weathered the global recession very well by reducing government spending and balancing their budgets, while the rest of Europe was doing the opposite. Estonia was back to 8% growth in 2011. Let us celebrate Milton Friedman's life and his tremendous impact in America and around the world.